Hey everyone! If you've been watching the markets lately, you've probably felt a little uneasy. There's a lot of chatter about a potential market crash, and with so much uncertainty out there, it's easy to get anxious. But what if I told you there's a legend in the financial world who has a plan for situations just like this? That's right, Warren Buffett, the Oracle of Omaha himself, has a hidden market crash strategy that's been key to his success. And today we're diving deep into exactly how Buffett not only survives market crashes, but thrives during them. Stick with us to the end, because we'll reveal the steps you can take to safeguard your wealth using his hidden plan. And if you find this video helpful, make sure to subscribe. It helps us create more valuable content just like this, and your support means a lot to us. Hit that notification bell so you won't miss out on future insights into wealth-building strategies. Let's get started. Before we dive into the specifics of Warren Buffett's hidden market crash plan, let's talk briefly about market crashes. What is a market crash and why do they happen? Market crashes are periods when stock prices experience sharp declines over a short period, often caused by a combination of economic, political, or global events. Crashes can be triggered by financial crises, geopolitical conflicts, or unexpected economic shocks like recessions or depressions. They lead to a sudden loss of wealth and can create widespread panic among investors. Most investors fear market crashes because they represent uncertainty. However, Warren Buffett has a different view. He doesn't see crashes as a reason for panic, but rather as opportunities. His long-standing philosophy, famously summarized by his quote, "Be fearful when others are greedy, and be greedy when others are fearful," illustrates how he capitalizes on these moments of market turmoil. Warren Buffett believes in value investing. This means he looks for companies that are trading below their intrinsic value, businesses that are fundamentally strong but temporarily undervalued by the market. During a market crash, many stocks are sold off due to fear and panic, leading to situations where high-quality companies are suddenly available at discounted prices. Buffett, however, remains calm and sees these times as a golden opportunity to invest. Let's explore how Buffett's strategy unfolds step by step. When it comes to preparing for and navigating through a market crash, Warren Buffett's approach can be broken down into several core strategies. Each of these components plays a crucial role in ensuring his success during periods of market turbulence. Here's an in-depth look at the specific elements that make up his hidden market crash plan. The first, and perhaps most critical aspect of Buffett's market crash strategy, is his commitment to keeping substantial cash reserves on hand. In the investing world, cash is often seen as a wasted asset because it doesn't generate immediate returns. But Buffett views cash differently. It's a weapon he can deploy when others are selling in a panic. During the 2008 financial crisis, while many investors were struggling to stay afloat, Buffett's Berkshire Hathaway had over $20 billion in cash reserves. This allowed him to make strategic investments in companies like Goldman Sachs and General Electric when their stock prices were at rock-bottom levels. By having cash ready to go, Buffett was able to acquire these assets at bargain prices and secure favorable terms for Berkshire Hathaway. Why is cash so important during a market crash? Because liquidity dries up. When everyone is selling and asset prices are falling, most investors are left with nothing to buy high-quality stocks at discounted prices. But those with cash can take advantage of these sales. By holding significant reserves, Buffett ensures that he can act swiftly and decisively during a downturn. Warren Buffett has a simple rule when it comes to buying stocks. Look for high-quality businesses with a strong competitive edge, and only buy them when they're on sale. A market crash is the perfect opportunity to do this because even the best businesses tend to see their stock prices fall during these periods. What does Buffett mean by high-quality businesses? Buffett looks for companies with durable competitive advantages, or what he calls an economic moat. These are businesses that have a strong brand, pricing power, a solid track record of profitability, and the ability to withstand competitive pressures over the long term. Examples of companies Buffett buys, Coca-Cola, Apple, and American Express, are just a few examples of companies Buffett has invested in over the years. Why? because these businesses have strong brands, loyal customer bases, and generate consistent cash flows. During a market crash, the stock prices of even these blue-chip companies can fall dramatically, but their underlying business remains strong. This is when Buffett moves in to buy. When markets are crashing, it's important to avoid getting caught up in the fear and instead focus on the long-term fundamentals of a company. As Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The goal is to acquire businesses that can grow over time and provide solid returns, even if their stock price is temporarily depressed. One of Buffett's greatest strengths as an investor is his emotional discipline. When markets are crashing and the news is filled with dire predictions, it's easy to panic and sell everything in a hurry. However, Buffett takes the opposite approach. He remains calm and avoids making rash decisions based on short-term market movements. In fact, Buffett often does the opposite of what most people are doing. While the average investor is selling during a crash, Buffett is buying. Why? Because he understands that market crashes are temporary. Over time, markets tend to recover, and the businesses he invests in will eventually regain their value. During the 2008 financial crisis, the stock market lost over 50% of its value, and many investors were in full-blown panic mode. However, Buffett remained calm. He continued to buy stocks and even famously wrote an op-ed in the New York Times titled, "Buy American. I Am." In the article, he urged investors to take advantage of the low prices and focus on the long-term value of the businesses, rather than being swayed by short-term fear. For regular investors, this emotional discipline is perhaps the hardest part of following Buffett's plan. It's easy to get caught up in the market hysteria and sell off your investments when prices are plummeting. However, Buffett's success comes from his ability to stay calm and focus on the bigger picture. Warren Buffett's market crash strategy revolves around one central principle: focus on the long-term fundamentals of a business rather than short-term market movements. This is where many investors go wrong during a crash. They get caught up in the daily fluctuations of the market and forget about the underlying value of the companies they're invested in. In Buffett's view, the stock market is a voting machine in the short run and a weighing machine in the long run. What this means is that short-term stock prices are driven by emotions, speculation, and market sentiment. However, over the long term, a company's true value will be reflected in its stock price. During a crash, Buffett advises investors to ignore the short-term volatility and focus on the fundamental value of the businesses they own. If the company is strong, has a solid balance sheet, and generates consistent profits, then the stock price will eventually recover. The key is to remain patient and not make decisions based on temporary market swings. Now that we've explored Warren Buffett's hidden market crash strategy, you might be wondering, how can I apply these principles to my own investing approach? While you may not have the same resources as Buffett, you can still follow his core strategies to protect and grow your wealth during a market crash. Here's how. One of the simplest ways to prepare for a market crash is by building up your cash reserves now. Even though it can be tempting to keep all your money fully invested in stocks, having cash on hand allows you to take advantage of buying opportunities when prices drop. If you're currently 100% invested, consider gradually reallocating a small portion of your portfolio into cash. You don't need to hold as much cash as Buffett, but having 10 to 20% of your assets in cash can give you the flexibility to make strategic moves during a downturn. Before a crash happens, make a list of high-quality businesses that you'd like to own or add to your portfolio. Focus on companies with strong brands, consistent profitability, and a durable competitive advantage. When the market crashes, these are the businesses you'll want to buy at a discount. Look for companies with a long history of earnings growth. Check their balance sheet for a healthy amount of cash and low levels of debt. Pay attention to their competitive position in the industry. Do they have a unique product or service that sets them apart from competitors? Once you've identified these companies, keep them on your watch list. When the next market crash happens, you'll be ready to move in and buy them at a discount. One of the most important lessons from Warren Buffett's strategy is to stay calm during periods of market volatility. Market crashes are inevitable and they can be unsettling. However, selling your investments in a panic is often the worst thing you can do. Instead, take a deep breath and remember that markets tend to recover over time. If you own high-quality businesses, there's no need to sell just because their stock price has dropped temporarily. In fact, market crashes are often the best time to add to your holdings if you have the cash available. The final piece of advice from Warren Buffett's market crash plan is to maintain a long-term perspective. When markets are crashing, it's easy to get caught up in the day-to-day fluctuations of stock prices. But Buffett's success comes from his ability to see beyond the short-term noise and focus on the long-term potential of his investments. If you're investing in high-quality companies with strong fundamentals, their stock prices will likely recover over time. The key is to remain patient, avoid making emotional decisions, and keep your focus on the bigger picture. Warren Buffett's hidden market crash plan isn't about reacting to the market, it's about preparing for it. By holding cash reserves, focusing on high-quality businesses, staying calm during periods of volatility, and maintaining a long-term perspective, Buffett has managed to turn market crashes into opportunities for wealth building. Remember, market crashes are a natural part of investing, but they don't have to be disastrous. With Warren Buffett's plan in mind, you can navigate these turbulent times with confidence and even come out ahead. And before you go, don't forget to hit that subscribe button. We have more content like this on the way, and your support helps us bring these valuable insights to you. Until next time, keep investing wisely and don't let fear drive your decisions.